Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 11, and we're working on the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. So we stopped on 9 and we're on number 10. Okay. All right, so let me get my pen. Right. And this here is says calculate the certain operating information for direct method. Right. Just as a quick aside and as a brief overview, if you watched the theory videos, right, then you saw that we had the operating activities, we had the investing activities, and we had the financing activities, and there were different activities for each one that were listed. So when you're creating the statement of cash flows, of course, you're going to have the heading, and then you're going to have the operating activity section, investing activity section, and the financing activity section. And in those sections, you're going to put those activities that apply for that particular section. And that's kind of like the basic template for it. Okay, and that's sort of the process. And as you've seen me so far, if you've been watching the videos, you've seen me work kind of like through that process, and I'm going to continue to work through that process. As I looked ahead, a lot of the exercises and especially the problems are doing nothing but creating the statement of cash flows. So in the creation of it, you'll see that same structure. But here's the thing. Depending upon the way the way you receive the data, okay, so far we've been kind of like just picking and choosing particular numbers, okay, because they've been quote unquote given to you. But the reality is that you're going to have to create this information yourself from the statements themselves, okay. So what's going to happen here is you should by now, or just through practice and doing the future exercises and problems, you should be able to create the structure of the statement of cash flows, but you're going to have to become accustomed to generating the specific numbers, okay? It's not as simple as let me pick a number off of a financial statement. You're going to have to do some math to come up with the correct dollar amount for that particular activity. And so right now in this short exercise 11-10, that's what we're starting to do. We're starting to get accustomed to having to manipulate the numbers to obtain the information that we need. So we have an income statement and a balance sheet here. And it says use the information from the financial statements to compute the following: collections from customers and payments for inventory. All right, collections from customers. What does collections from customers mean? Okay, well, when we get money from when things come from customers, we either receive cash or it's from an accounts receivable. All right. So we're not going to take this cash amount here and try to break it all down. That's not what's being asked. What's being asked here is the collection from customers. So that means we're going to be dealing here with our accounts receivable and what we're collecting from the cash from the accounts receivable. Now notice at the end of 2013 we have, and these are in thousands of dollars, we have $43,000 at the end of 2013, and our accounts receivable increased to $63,000 at the end of 2014. You can't just go and say 63,000 less 43,000 gives me, oh, I collected $20,000. Okay, that's not how accounts receivable works. Okay, and that's not how you're going to get that number. You have to start thinking about the totality of the concept. Okay. In a previous video, I forget which one, actually it was in the either the first video for the theory, first or second video for the theory, I think. Yeah, probably the first. I had said that, okay, imagine, it was when we were talking about the cash versus accrual, and I had presented the cash as, let's say you buy, somebody buys something, okay, and they pay cash. You're going to debit your cash, and you're going to credit your accounts receivable. I'm sorry, you're going to credit your revenue. But then from the accrual side, if someone buys something on account, we're going to debit the accounts receivable, and we're going to credit our sale or our revenue. And then we're going to, when that person pays it off, then we'll debit our cash and credit our accounts receivable. And this is nothing, this shouldn't be any new news to you and, earth-shattering, oh, I have some kind of epiphany here. You should already know this stuff. Right? But the point being here is that, our accounts receivable, they wash each other out. And so all we're left with is the same credit to revenue and the same debit to cash. So what we're doing here when we have the collections from customers, okay, we can't just go and say, oh, it's the difference between our year ends, the 63 versus the 43. No, we have to take into consideration what was sold, all right, because we're trying to figure out the portion of the accounts receivable that was in cash. So the easiest way to do this is to start working with T accounts again. Remember, T accounts are a tool, all right? You've used them way back in the beginning of the textbook in theory. In the first chapters, I had said the T accounts are a tool for the accountant or a tool for you to use, and you could use it in many different fashions, okay? It's not like, oh, you learn how to use a T account just to look at a general ledger account, right? No, you also learned how to use the T accounts in order to make journal entries. Well, now you're using a T account again, in order to analyze the information. In this case here, we're going to look at our accounts receivable. And we had started out with a beginning balance of 43,000. Okay. Now, it tells us that our ending balance is going to be 63, right? So 63,000 is our ending balance, right? Think about the process. If we start out with 43,000, okay, and then we make these sales, so we're making that journal entry to debit accounts receivable and credit our revenue, right? That's the journal entry. We're doing that because we're using accounts receivable. So we have to look at our sales revenue, and we see our sales revenue is 684,000. Right? Now, obviously, 43,000 plus 684,000 doesn't equal 63,000. Right? What's the second half of that concept? The debit to cash and the credit to accounts receivable, right? So we're looking at the credit to accounts receivable. We have to figure out how much that credit to accounts receivable is, right? Because that's going to be the cash received from the customer. That's why it's this credit right here, right? And of course we know that if you know 3 out of 4 things, you can always figure out the remaining item there, okay? So if we have a beginning balance of 43,000 and we add in the 684,000, that's 727,000, all right? But then we have to subtract out our ending balance of 63, and that gives us a cash received, a collection from customers of 664,000, right? So this is going to be 664,000. Right? and that's how much our collection from customers is. All right. So again, the important thing here is don't just go and look at the numbers, subtract the two. You have to think about the way the transactions occur and what affects certain things. Sales revenue affects your accounts receivable, so we have to take that into consideration. And when you look at the T account, it's easy to understand how much we collected in cash because of that journal entry we make when we credit accounts receivable in order to debit the cash. All right, so pause the video there, and because I'm going to erase it and then work on part 2 here. Okay. Now, for 2, it says payments for inventory. Okay, so if I have payments for inventory, I'm going to be affecting the inventory account, and I'm also going to be affecting my accounts payable, right? Because I'm going to purchase stuff, all right, as far as inventory is concerned. So when I look at my inventory, I have a beginning balance of 84,000. Right? Now, I also have my ending balance of 77. And again, this is not a subtract one number from the other. You have to think through the process. Okay. When I have inventory, okay, if I have 84,000, well, let's just say I had 184,000. And this is an example, right? If I had 184,000 of inventory, that's my beginning balance, and I make a sale for 100,000, right? What are my journal entries? Well, my journal entry is, and let's just say it's in accounts payable, all right? I'm going to, I'm in accounts receivable, I'm sorry. I'm going to debit my accounts receivable for the 100,000, and I'm going to credit my sale for the 100,000, right? But whenever we make a sale, whenever we have revenue, and it comes out of inventory, we know we have to make a second journal entry, right? And this is not something new again. This is just trying to, have you think from the perspective of, I have to think about everything. It doesn't have to be on the paper, right? It's understanding the concepts and then applying what I need to the situation at hand. So when I make that particular sale for 100,000, I also have to make the entry to debit my cost of goods sold and credit my inventory for the 100,000 in order to move it out of inventory and into cost of goods sold. So I have my inventory minus my cost of goods sold. Okay, that's going to be moving that, which gives me an ending inventory of 84, right? Okay, so with that kind of understanding in hand, what other account do I have to look at? Well, I have my cost of goods sold, all right? In this case here, that's 334,000. So if I made that entry to credit debit my cost of goods sold and credit my inventory, I'm going to have the credit for inventory for 334,000. So the question is how much is that amount right there? Okay. Now, to find that amount, right? I'm going to debits less my credits, right? So if I have 334,000 in credits and I have 84,000 in debits, right, that means that I have 0, let's see, 0, 1, boy, my brain just froze up here. Yeah, that's 250,000, right? But then we also need to get, we're going to add back in to get back to our 77,000, right? So I have to add that in, 7, 2, so that's 327,000. I had brain freeze there for a second. So this number, our debit to our inventory, is going to be 327,000, right? So go ahead and, if you didn't get that, let's do the math from just looking at it itself. 84 plus 327 is 11, 10, 11, that's 411. And then we subtract out the 334, and we end up with 77. All right, that's, to get to that bottom line. Right? So let me just quickly go over that again without knowing the 327. If I have a credit of 334 and I have a debit of 84, I subtract one from the other, and that gives me 250. But then I need to get to 77, so I have to add back in the 77. So I know that that additional debit is 327, right? So I have 327 as affecting my inventory. But the question, we're talking about what the payments for inventory are, right? So we have to look at our accounts payable. And in our accounts payable, we have an ending balance of 32, okay? And we know that we had purchases of 327, right? And this brings, and we want to get to the final balance of 55, right? So we have to do the math in order to get to that, that payment for the inventory. Because remember, when we pay, when we buy inventory, so we're going to debit inventory, credit accounts payable, okay? And then when we pay off the accounts payable, we're going to debit the accounts payable and credit our cash, right? So this debit to the accounts payable is what we're looking for when we're paying it off. So we know what the payment for inventory is. So let's do the math for that. Okay, so we've got a credit of 32 and a credit of 327. So that's 359, right? That's our credits, and we need to end up with a credit of 55, so we have to subtract out that 55, and that means our debit is going to be 304. Right? So that's our payment for our inventory is this 304. Right? So I'm not going to go back over that again. Pause the video if you have to, watch it again. But the important point here is realize that now you're going. In the as far as the exercises are concerned, it was here create a statement, but now you're going to start getting more involved in the generation of the numbers. You learned, or you were introduced to the different activities, but how do you arrive at that number? Before you were given the numbers. Now you're going to actually have to start calculating the numbers yourself. And then, because you're just going to get the data on your financial statements here, right? And you can't just pick numbers like you were before. You have to think through the totality of the concepts in order to be able to generate those numbers. So, watch the videos again, and in order to see where they come from. Realize that you're not going to be able to have a video for each and every possible situation, all right? You're always going to have new situations, and up to this point in time, if you've been learning what you've needed to learn, you have, you should understand all of those concepts and to be able to handle whatever situation is given to you. So, and then if you still don't understand something, or you're struggling with it, obviously you can always just telephone and speak with an instructor. All right. So I'll see you in the next video for the next exercise.